Hello, welcome to 2021. If you're a returning viewer, a regular, thank you very much. I really appreciate your support and your company. If you are new to the channel and you just stumbled across this video, I hope you'd consider subscribing. We are trying to build insurance related topics that would interest people so that they can continue to understand and be engaged with their super funds and understand what insurance offering they are getting from their superannuation arrangement. We are off to a fresh start in 2021, and what better way than to actually give you some tips on how much insurance you need. I have created a whiteboard video to help share some of the tips I wanted to share with you. So let's watch and then I'll see you at the other end. So, how much insurance cover do you actually need? This is actually a very random question, and most people don't really know where to begin. Let's start with income protection cover, sometimes also referred to as temporary disablement cover. Income protection cover generally provides you with a monthly income benefit in arrears when you are temporarily unable to continue working. Not because you're unemployed, but because due to injury or illness, you can't work. Some funds will offer you a choice of waiting period or benefit period, but the insured amount is often only 75% of your salary or income. Be aware that your salary or income will have a very specific definition depending on which fund you're with. It may not include variable or irregular amounts like bonuses, overtime, investment income. Some funds may allow commissions or shift allowances, and it's averaged over an agreed period of time. But you'll need to look at the specific definition that applies to you. In some instances, you can also insure your super contributions, mainly because when you're not working, you're also missing on the ongoing ability to continue to contribute to your super fund. But in the event of a claim and when it's paid, that will not be paid directly to you. It'll be paid to your super fund. Back to the 75%. If you're only going to get 75% of your salary, then the shortfall of 25% of your salary or income should guide your thinking when determining your permanent disablement cover in case your disability is no longer temporary. The example of salary amount we're using here was derived from the ABS's average weekly ordinary time earnings in May 2020. Okay, now that we've established that, let's talk about total and permanent disablement cover. Unlike income protection that's paid monthly in arrears, TPD cover is paid as a lump sum amount. Therefore, you need to think about the number of years you would have worked till retirement and how much you would have saved if you were able to continue to contribute through your super, and where that money is going to come from if you were suddenly robbed of the opportunity to do so due to an injury or illness, preventing you from ever working again. So a good starting point would be 25% of your salary and multiply this by the number of years you had remaining to retirement. That number will be different for everyone, but should guide your thinking when estimating the amount of TPD insurance cover you need. When thinking about more or less, the amount of insurance cover you need will depend on your current financial commitments and financial dependence, and if you have a partner, your partner's ability to shoulder all the expenses. Your current cover may not be enough, or maybe it is, but it's a good starting point when you have a conversation with your financial advisor. In framing your decision, there are some important notes I need to remind you. Some funds may not offer insured amounts as a percentage of salary. Sometimes it is based on your age. Therefore, you will need to find the equivalent amount based on the number of units relevant to your age. With the example we just used, your insured cover amount will be higher if your salary is higher. It will be lower if you're older because the number of years to retirement will be less, and it will continue to reduce as you get older, unless you chose a fixed amount, which means the amount of cover will remain constant until your cover ceases. And finally, if you do need to increase your current level of cover, be prepared because you'll be required to be underwritten if you wish to increase your current levels of cover. These tips are not intended to replace the advice of a licensed professional. Therefore, consider if having a financial advisor is appropriate for you when framing your decision. Okay, I hope you've picked up some useful tips from that video. Again, I cannot stress enough, it is not financial advice. I'm simply giving you some tips so that you've got a starting position to guide your thinking when you go and speak to your financial advisor. I hope you're enjoying this content. If you are, please consider subscribing so that you can get notified of future videos whenever I post them. I hope you tune in again soon.